In today's video, I'm going to explain why municipal bonds are worth having in your portfolio, which happen to be tax-free investments federally and potentially tax-free at the state level if you buy them local to your area. And for those of you that aren't familiar, municipal bonds or munis are just like any other bond, where you, the investor, are loaning out your hard-earned money to a city or state government agency, where they're going to be paying you back interest on a regular interval, roughly every 6 months. And when it reaches maturity, you will be paid back your original investment, or also referred to as the principal. And what makes munis so appealing is that they are not taxed at the federal level. And if you do purchase them specific to your community, then they're probably free of taxes at the state level as well. But you'll need to research the bond on your own just to verify those details. And you may be asking yourself, if munis are tax-free investments, then why isn't everyone investing in them? And the reason is simple. The rates tend to be quite a bit lower on munis than the rates on most any other bond. However, if you're in a higher tax bracket and live in a state with high taxes, then municipal bonds could offer you a much better yield. Let's illustrate this by comparing a municipal bond of 4% to a CD, or a certificate of deposit, that is at 5%. For this example, let's say that you live in New York, where your gross income is $150,000. Your effective tax rate for the state is at 4.94%. And if you enter that into a tax equivalent yield calculator like this one from Bankrate, it shows that your 4% municipal bond has a tax equivalent yield of 5.33% from saving on federal taxes, and it is up to 5.61% if you combine the federal and state tax savings. If you're looking at investing in munis, then I highly recommend that you use a calculator just like this one to get your tax equivalent return. And I will have a link in the description below just to save yourself a little bit of effort. From what I've shown you, you can now see why municipal bonds are a great investment if you're in a higher tax bracket and when you live in states with a much higher income tax rate. But there may be some of you out there that simply want a relatively safe investment that provides you regular dividends or interest payments. Now, there happen to be two key risks associated with municipal bonds. The first is the interest rate risk. Let's say that you buy a municipal bond today for 4%, and in 1 year that rate goes up to 5%. Since your bond is locked in for potentially years on end at 4%, you're going to be missing out on that higher rate, the 5%. And if you wanted to sell yours early on the secondary market, you would be losing money simply because you would need to offer a discount in order to sell yours so that you would be competing with the new bonds that are at 5%. This happens to be a very common risk with any fixed income asset like CDs and bonds. I believe that most of you are aware of this risk, but I just want to put it on the table for everyone to see. The second major risk is credit risk. Whoever owes you money, they may default on the loan or the bond. Government bonds are seen as zero or no risk because the US can essentially print themselves more money. But overall, they simply pay their debt. Local government bonds, like munis, are seen as very low risk, but not as low as the US government bonds. And then, of course, there's the corporate high-yield bonds that offer a much higher yield, as the name suggests, but they also come with a much higher risk of default. And all three types of these bonds are available to purchase on an exchange where you can quickly review and compare them all to see which option may be best for you. One thing that I really like about municipal bonds is that they're given a credit rating to assess the creditworthiness of the state or the local government that's issuing the bond. The ratings are based on factors like the issuer's financial condition, the strength of its economy, and the security of its revenue stream. The most common rating agencies for municipal bonds are Moody's Investors Service, Standard & Poor's, and Fitch Ratings. Each agency uses a different rating scale, but they all follow a similar structure. The highest rating is a AAA, which indicates that the issuer has an extremely strong capacity to pay back interest and its principal. And following that up is the lowest rating of a C, which indicates that the issuer has a very high risk of default. In general, bonds with higher ratings are considered to be less risky, and therefore command a lower interest rate. Bonds with lower ratings are considered to be much more risky, and therefore command a much higher interest rate. As a quick illustration, here's a chart outlining the common ratings of these bonds along with the definition of each. The key item to keep in mind is that AAA is the best and CCC is going to be the lowest tier in the ranking, and it tends to come with much more risk. Reducing risk and finding gains, well, it's a tricky balance. but we can raise our portfolio's floor and ceiling by diversifying across assets. No one was spared from volatility last year, and it led to many investors like us losing billions. At one point, Barclays calculations found that cross-asset correlation was at its highest levels in 17 years. Somehow, we bought ourselves some time to find safe havens, and some investors found annualized net returns of 17.8%, 21.5%, and even 35% last year because they unlocked the potential of low correlation assets with Masterworks. Masterworks has driven over $45 million worth in art sales so far. 14 sales and counting, each of them delivering a profit to investors just like you. Many of you know by now that dozens of you are already on board. They're giving you access to an asset class that was only available to the ultra wealthy. With a long history of resilience in the face of volatility, past performance isn't indicative of future returns. But over 750,000 people are already on board, and demand is still climbing. And since your response has been so strong so far, Masterworks is extending their offer for you to skip the waitlist and get started today. Just click the link in the description below. I want to cover a few basics about municipal bonds, such as where can you even purchase them? This is a question that I often get, and the most common place to buy them is from your brokerage site or an exchange like Fidelity, Vanguard, or even Schwab. They have a dedicated section that lists the municipal bonds offering as either new or ones that have already been previously owned and they're being sold on the secondary market. And when you search for bonds on a brokerage site, they give you the option to search local to your state so you can try to buy ones where you'll be getting the benefit of no state tax. However, your state may not be offering any new municipal bonds, or if they do, the rates are incredibly low. If that's the case, you can certainly look at other states, but please take into account the fact that you won't be receiving any of the goodness from no state tax. And there's also the option to look on the secondary market for used municipal bonds that someone is simply trying to sell from their individual portfolio. This way, it may give you a few more options that are specific to your state. Another question that I often get is, what resources do I use when I'm researching for my stocks and my investments? I often use the brokerage sites for performance information, but I also like to get as close to the source as possible with sites like NASDAQ. In fact, I've been collaborating with a publisher by the name of Header, where they are kind enough to provide me some of their first-hand research. So rest assured, I'm leveraging reputable sources. And for any of you whose preferred learning style is reading, then many of the topics that I cover within my videos are in written form from this publisher. I'll leave a set of links in the description below of all the different resources that I use if you're interested. I think that it's important to start off by describing the process of buying a bond in very general terms. When you buy a bond from an exchange, the price that you buy it for, let's say it's $1,000. That original price is going to be called the par value. It's the value it is originally sold for, and it's the amount that you're going to be given back at maturity. So the starting price and the ending principal are the same on a bond, and it's the par value. For example, let's say that the par value of a bond is $1,000 with a coupon rate of 4%, but you buy it at a discount on the secondary market for $990. Since the coupon rate is 4%, that's the annual percentage yield that you will be getting back on the bond. But when it matures, you'll be getting the full par value of $1,000 back. This is very important to understand when bonds are both bought and sold on the secondary market. Regardless of whether you buy a new or a used bond, they do have terms that forever live with that bond until it matures. It's a different language than most of us are used to, but once you're around it enough, it slowly becomes second nature. And another basic item to consider with municipal bonds is that they are meant to be purchased in your taxable account due to the tax savings with these bonds. So for this reason, a person would not want to buy them in your 401k or your IRA because the tax savings that you get from a muni is completely lost on these types of tax advantaged accounts. I get a lot of questions from viewers asking whether or not they can buy munis in their 401k. And the simple answer, well, is yes. And since I can't provide individual investing advice, all I can say is that I would never choose to buy a muni in my tax advantage account like my IRA or my 401k. Now, there is another option for buying municipal bonds, and that's through an ETF or an exchange-traded fund. This concept happens to be much harder to explain in a video, so I'm not going to be covering it today. However, ETF that are made up of bonds in general have a whole other set of terms used to describe the average holding time to maturity and the average time to get back your initial principal. Because the fund manager is constantly buying and selling bonds, the timing, the rate of return, and the ETF price are constantly competing against one another, and it makes it extremely difficult to try to explain this in simple terms. I can certainly go over that in another video if you would like me to, but hey, just let me know in the comments if that is something of value. But for now, I am going to stick with the more straightforward approach of buying munis as either being new or used from a broker. Now, in looking to buy a municipal bond, I'm going to be using the website Fidelity simply because they have a bit of a cleaner view, and that happens to be my preference. Now, their first landing page lists all types of bonds and CDs, and I love how it shows what all the different assets have for a rate across all the different time intervals. You can look at the 1 year and see that a corporate bond has the highest rate of return within the group at just over 8%. But for our needs, let's go to the Bonds tab. From here, there's another set of tabs where you can select Municipal. And when you do that, the screen defaults to Used Bonds. If you want to look at the new ones, you do need to click on the New Issue link. And in doing so, this is the list of options for new municipal bonds. On the screen, there's only 23 available, and the state options are very limited. Because it's so limited, I'm going to go back to the screen and look at the secondary market. And from here, it's showing thousands of options. But I like to adjust the ask yield to worst up to a minimum of around 4%. And then I like to select my state. Let's say that I'm from New York to keep with my prior examples. And when I hit enter, it brings up the next screen of all my options for New York that offer above a 4%. I want to sort these in descending order from the yield to maturity. So I simply click on the yield to maturity and it will descend the list based on that feature. And it has the down arrow next to it to let me know that it's sorted. On this screen, let's review the columns that I think are the most important. The coupon is the initial rate for this bond, which is a 5. So that means it provides a 5% annual rate for the interest payment. Since there is a call date listed, this bond is not call protected, which means that the issuer can review the bond on that date and decide whether or not they want to cancel the bond altogether and pay back all the owed interest and the principal for that bond. And then they can reissue the bond at a newer, lower rate. Then I look at the rating, and then they list the price per bond and the minimum quantity. In this case, the par value would be at $100, and they're asking for a price of $100.31, which is higher than the par value, which means that they're selling it for a premium. And because of that, the yield to maturity number is at 4.957 and not a 5 like the coupon rate. This person is trying to sell their bond at a slight premium to make a few bucks in the short term. Now, I do want to mention that the column of yield to worst, which is at 4.032. This means that if the bond is called back from the issuer, you are guaranteed at least the rate of return of 4.032%. And yes, that is a decent drop from the yield to maturity, and it's just another item that you want to watch out for. Let's go ahead and click on the bond name to see more details. On this screen, you can see that it pays semi-annually and the bond is not call protected. On the plus side, you can see that this bond was issued in 2014, and even though it is callable, they are still maintaining the 5% coupon rate. From here, I'll click on the buy button, and then it brings me to the screen for making the actual purchase. And here it does show me the ask price of $100.31, and the ask yield is matching the yield to worst if it is called. The quantity minimum is at 5. So if you enter a quantity of 5, that's going to be $5,000 that you are investing in this bond. Next, I want to show you the cell that you want to look at, and that's the limit price. And you can change that if you like. Me personally, I would enter the price similar to the third-party price that is shown above, since I do know that's a comparison of what's more acceptable in the market. Next, I have the box of fill or kill marked so that either the issuer is going to fill my entire order of the 5, or they're going to kill my entire order. Next, I would review the order just before executing the purchase. Look, the process of buying bonds can seem challenging due to all the different languages and the different terms that are being used. But I get it. I was once learning all the different terms from scratch, just like you. And if you're looking to invest in fixed income assets, I highly recommend that you shop around. Look at the different types of bonds. Look at the different types of CDs. In fact, when buying CDs on a brokerage site just like this, it can be equally as foreign. And if you do want some guidance on that, I did make this video right here to guide you through that entire process of buying them from a brokerage site, just like Fidelity.